In just a few hours, more than $600 billion vanished from the market, and then came right back. That kind of move does not happen in normal conditions. Healthy markets don't erase and restore that much value inside a single session. When you see swings like this, it's not volatility, it's stress. To understand why this matters, you have to look at how rare this behavior is. A 1% move in major indices usually plays out over days, sometimes weeks. Compressing that level of damage and recovery into hours puts this event in the same category as crisis periods. COVID crash, 2008. Forced liquidation events, not stable markets, not orderly corrections. Speed matters. When money moves this fast, it's not reallocating, it's being forced. Look at what happened across the broader market. Stocks dumped hard, then ripped higher just as fast. Correlations broke down. Assets that normally offset each other moved in the same direction. That's the fingerprint of deleveraging. When leverage is involved, funds don't sell what they want, they sell what they can. Liquidity becomes the only objective. Fundamentals stop mattering. Cash is all that matters. This is how liquidity stress works mechanically. The dollar rises. Volatility spikes. Treasury yields fall as capital moves defensively. Risk assets get sold together, regardless of quality. This isn't panic, it's math. Positions built on borrowed money have to be unwound when collateral drops. That unwind happens automatically. This pattern has been documented for decades. Markets expand, confidence grows, leverage builds quietly beneath the surface. Then something snaps, and forced selling takes over. Price dislocations always come first. Explanations come later. Fundamentals reassert only after the forced sellers are done. From a technical perspective, these moves aren't about direction yet. They're about information. Key levels are being violated and reclaimed rapidly, showing positioning stress rather than conviction. Options markets reflect this with expanding implied volatility that doesn't predict up or down, it predicts turbulence. High open interest near major levels increases pressure, accelerating both drops and rebounds. Sentiment flipped instantly. One moment everything was fine. Hours later, fear took over. Then confidence returned just as quickly. That emotional whiplash is not a sign of stability. Structural problems do not resolve in one session. Leverage does not disappear overnight. Liquidity stress does not politely announce itself. Extreme sentiment swings usually appear when markets are least understood, not when they are safest. Here's the reality. Massive intraday reversals, correlation breakdowns, rising volatility alongside falling yields, a stronger dollar, clear signs of forced liquidation. Volatility is not coming, it's already here. Direction is uncertain, and that's not the danger. Misreading the environment is. Markets aren't stressed because prices moved fast. Prices move fast because markets are stressed. Logic over noise, data over headlines. That's how you stay standing when things start moving like this.